Welcome to the Deep Dive. Today we're plunging into a company where the outcome for investors feels really binary. Substantial gains, potentially, or, well, maybe a near total loss of capital.
It's a true high-stakes situation. We're talking Eos Energy Enterprises, ticker EOSE on NASDAQ.
Right. And they're right in the thick of this race to build a cleaner, more resilient energy grid using novel zinc-based battery tech.
Exactly. And the core tension, the big question we're exploring is, can this tech realistically disrupt the lithium-ion dominance? Or will the company's financials, frankly, snuff out the promise before it gets going?
So our mission today is to help you understand the key factors here. We'll unpack Eos Energy, its business, leadership, financials, market view, the whole picture based on the sources we've got.
And just for context, we're doing this analysis as of June 27th, 2025. The share price we're using is $4.21 from the close on June 25th.
We've split this deep dive into two parts. Part one, business management financials.
And then part two, market sentiment, who owns the stock, risks, and our final thoughts. Sound good?
Sounds great. Let's jump into part one.
Chapter 1, business understanding.
Okay, so Eos Energy. What's the core business?
They design, develop, manufacture, and sell these long-duration stationary energy storage solutions. Think big batteries.
For who, mainly?
Primarily utility-scale customers, the grid operators, also commercial and industrial markets. Their main moneymaker is selling these battery energy storage systems, or BESS.
But I saw something about recurring revenue, too.
Yeah, that's smart. They're building a secondary stream with long-term service agreements, like 7 to 15 years. Think of it as a kind of razor and blades model.
Right. Sell the system, then lock in service revenue. How big is that piece?
Well, as of late 2021, they had a $34 million backlog just for those service agreements. So it's becoming a real factor.
And operationally, they seem quite disciplined, maybe unusually so.
They are. Their strategy is to build manufacturing capacity after they get firm customer orders.
Which avoids what happened to some other battery startups, right?
Yeah.
Building huge factories too soon.
Oh. Exactly. Like Aquion and Alevo, they burned through cash building capacity that wasn't matched by demand. Eos is trying hard to avoid that specific pitfall.
But does that slow them down if demand suddenly surges?
That's the trade-off, isn't it? It mitigates financial risk, sure, but it could potentially limit their ability to scale up super fast if the market takes off quicker than expected. It's a real tightrope walk.
Okay, let's talk tech. The core is this Eos Znith.
Correct. Proprietary aqueous zinc battery technology. It's the foundation for their modular systems, the Z3 Cube Hanger Stack.
And these are specifically for long-duration storage, LDES.
Yep. Typically discharging power for 3 to 12 hours. That's a key difference from standard lithium-ion, which is usually more like 1 to 4 hours.
And they have their own battery management system, the BMS.
They do. Proprietary, American-made. It's critical. The brain of the system manages performance, safety, efficiency. They claim above 80%, sometimes over 90% efficiency.
So market position. They're aiming to be the American alternative.
Pretty much. A leading U.S. innovator in this growing LDES space, providing a domestic option compared to the mostly Asian-sourced lithium-ion batteries.
Still a smaller player, though, right? Market cap around $1 billion.
Yeah, about $1.07 billion as of mid-2025. Definitely an emerging player, aiming for that non-lithium-ion niche leadership.
They talk about a huge pipeline, $15.6 billion, and a firm backlog of nearly $700 million.
That's right, $680.9 million backlog as of March 31st, 2025. Shows real market interest, no doubt.
And this seems like a big but, the actual deployment.
That's the reality check. As of Q3 2023, total deployed capacity was less than 50 milliwatters. Tiny, really.
So converting that massive backlog into revenue, into actual operating systems, that's the mountain they need to climb.
Absolutely. That's the core challenge, industrializing the tech, scaling up production efficiently. They got about 430 employees, mostly at their main facility in Turtle Creek, Pennsylvania.
Which is near their suppliers, I read.
Yeah, strategically located near about 80% of them. Helps with that Made in America angle.
Okay, so summarizing their value proposition. 3 key things versus lithium-ion.
Right. Pillar 1, enhanced safety. Their zinc chemistry is inherently non-flammable. That's a massive plus compared to lithium-ion's thermal runaway risks. Huge for utilities.
Pillar 2.
Sustainability and supply chain security. They use common materials, zinc, water, abundant, recyclable, avoids conflict minerals like cobalt, and avoids lithium dependency. Plus, the U.S. manufacturing helps with IRA incentives.
And third,
Cost effectiveness for long duration. They claim they're price competitive, even cheaper for those longer 3 to 12-hour storage needs where lithium-ion gets really expensive.
let's look at the industry itself. LDES market growth.
It's really taking off. An inflection point. Projections are, $14 billion to maybe $32 billion by the early 2030s. That's like 14% annual growth. Some forecasts go way higher, over $200 billion by 2044.
What's driving that kind of growth?
A few big things. Integrating more renewables like solar and wind onto the grid, modernizing the grid itself, making it more resilient, government policies, the IRA, DOE initiatives, and now this emerging demand from massive data centers powering AI.
They need huge amounts of stable power. Okay, competition. Who are they up against?
It's dynamic. You've got direct competitors using other alternative chemistries. Think ESS Tech with iron flow batteries, Energy Vault with gravity storage, and now other batteries too.
But the main competitor is still
Lithium-ion, absolutely. The 800-pound gorilla. Huge scale. Established supply chains. Costs are still coming down. Eos has to prove it's better in key ways, not just different, to displace that.
So it's EOS, ESS, Energy Vault, maybe Fluence. But really, they're all fighting lithium-ion's shadow.
That's a good way to put it. And the regulatory side, mostly helpful now in the U.S.
Increasingly favorable, yes.
Yep.
The IRA is a big boost with tax credits and domestic content bonuses. Lots of states, maybe 17 or so, are setting storage targets. California, New York, New Jersey.
But it's not all smooth sailing, regulation-wise.
No, navigating the safety codes like UL 9540 for fire safety and the grid interconnection rules. That's complex. Adds time and cost to every single project. It's a real hurdle.
So barriers to entry are pretty high then.
Definitely. Huge capital costs for R&D and factories, hundreds of millions.
Right.
Big tech and manufacturing challenges to scale up, complex supply chains, and that tricky regulatory landscape we just mentioned.
How about Eos' competitive advantages? Brand strength.
They've built recognition in their niche, known for being that safe, American-made alternative. Partnerships with Shell, National Grid, Duke Energy help. Hosting the energy secretary was a good PR moment, too.
But cost advantages, that's still theoretical.
Very much so. Based on cheap materials like zinc, yes. But the reality right now is a disadvantage in scale. Their gross margins are deeply negative. Production costs dwarf revenue.
Ouch. So viability really hinges on getting those automated lines running and driving down unit costs.
Completely. That's the whole ballgame for them financially.
Network effects,
Yeah.
switching costs.
Not strong network effects like in software, but switching costs could be significant once a utility integrates their hardware, their BMS, trained staff. It could make customers sticky later on.
Yeah.
And unique assets. What really stands out?
Two main things. One, their proprietary Zenith IP, the patents around their zinc chemistry, that's unique.
Hidden too?
Their U.S. manufacturing capability in Pennsylvania, that's strategic for supply chain security and those IRA benefits.
But tariffs, could they still be a risk even with U.S. manufacturing?
It's nuanced. They're protected from tariffs on finished imported batteries, but tariffs on raw materials or specialized manufacturing equipment they might import, that could still raise their costs.
And the general uncertainty tariffs create.
Right. That can cause industry-wide project delays, which hurts everyone trying to convert their pipeline, including Eos.
Okay, let's shift focus to the leadership. Who's running the show?
Chapter 2, Management Evaluation.
The CEO is Joe Mastrangelo. Lots of experience, right? GE background.
Yeah, nearly 3 decades in energy, including big roles at GE. He's overseen the SPAC deal, the early commercial struggles at Eos.
But there's some concern about executive pay versus performance.
There is. Compensation has gone up even while the company has been deeply unprofitable. That tends to raise eyebrows with investors.
And they've faced a major crisis recently, haven't they? The CFO situation.
A severe test, yes. CFO Eric Chaviti was terminated abruptly in May 2025. He'd only been there 3 months.
And the explanation was vague.
Very vague. Which, combined with the stock tanking and a securities fraud probe being launched by the Pomerantz law firm, it's a significant red flag, casts a shadow over governance and crisis management.
How have they responded to things like short seller reports?
Mostly by saying they're focused on execution and getting financing sorted. But this CFO issue is a much bigger internal problem.
So communication and transparency. Questionable.
You could say that. The vague CFO statement, some past issues with how they reported backlog figures.
Yeah.
It raises questions, and that Pomerantz probe definitely impacts their ethical reputation right now.
Okay, capital allocation. Where's the money going?
Survival and growth, basically. Funding the operational losses and investing in the core business.
Top priorities.
Scaling and automating that Turtle Creek factory. They need to hit that 2-gitter WOB to target, get the second line running H1 2026. That's non-negotiable for profitability, plus ongoing R&D investment.
M&A history. Pretty limited.
Very. The SPAC was pivotal for initial capital, and acquiring High Power in 2021 gave them full control of manufacturing. That's about it.
Let's talk about that recent capital raise in June 2025. Sounds like a really big deal.
Oh, it was critical. A high leverage move, a real bet the company moment. They raised $336 million through stock and convertible notes.
What did that achieve?
It let them restructure debt, push out when it's due, and crucially, get their lenders to waive restrictive financial covenants until March 2027.
So it buys them time, a 2-year window.
Exactly. A crucial window to hopefully achieve positive gross margins. But the cost was steep, significant shareholder dilution, and a more complex debt situation down the road. It was a lifeline, but an expensive one.
Share buybacks, dividends.
None. As you'd expect for a company like this, they need every penny for reinvestment, no plans for either.
And return on invested capital, ROIC.
Deeply, deeply negative, like negative 139% for FY 2024, negative 132% trailing 12 months through March 2025.
And their cost of capital, WACC, is high, 17–20%.
Right, so the negative ROIC compared to that high WACC means they're currently destroying value. The whole bull case relies on future investments turning that around dramatically, getting ROIC above WACC, a huge hurdle.
Okay, let's dive into the financial nitty-gritty.
Chapter 3, Financial Analysis.
Market cap again, about $1.07 billion. Small cap.
Yep, small cap segment. And that valuation clearly bakes in a lot of future optimism given where their current numbers are.
Revenue trends, looks pretty choppy.
Very volatile. Basically zero in 2020, then $4.6 million, $17.9 million in 22, dipped a bit in 23 due to a product phase out, then $15.6 million in 2024.
But the guidance for 2025 is huge.
That's the key. Management guidance is $150 to $190 million, a tenfold jump. But it absolutely depends on that automated manufacturing line ramping up successfully.
And analysts are even more bullish, some over $1 billion for 2025.
Yeah, some consensus forecasts are as high as $1.276 billion. That massive disconnect between company guidance and some analysts' hopes highlights just how uncertain that ramp-up is.
Profit margins. These are tough to look at.
They are alarming. Gross margin TTM is negative 442%. They lost $83 million on $15 million in revenue in FY24. Costs are just way out of line with sales right now.
Operating margin, net margin, also deeply negative.
Hugely. Operating margin TTM 99%, net margin TTM negative 4,225%. Profitability requires a complete reversal through scale and automation. It's the entire story.
Free cash flow, consistently burning cash.
Consistently and significantly. TTM SCF ending March 31st, 2025 was negative $176 million burn. That high burn rate just hammers home why that June capital raise was essential.
Earnings consistency, consistently loss-making.
Yes. Substantial and growing net losses year after year, from NASDAQ $60 million in 2020 to NASDAQ $686 million in 2024, though that latter number included big non-cash charges.
When do analysts expect break-even?
The forecast is for EPS break-even sometime in 2026. That's a massive milestone they need to hit.
Financial stability, debt-to-equity ratio.
Doesn't really mean anything here because stockholder equity is negative. They have an insolvent balance sheet. Liabilities far exceed assets plus equity.
So their survival depends on
continuing to raise new capital. Access to capital markets is everything for them right now.
What about the current ratio? Looked okay at 2.05.
Looks okay on the surface, yeah. Usually over 1 or 2 is good liquidity, but it's misleading. That ratio is inflated by the cash they just raised in June, which, as we know, is being burned through rapidly, so it's not as comfortable as the number suggests.
Valuation metrics. PE is useless.
Meaningless with negative earnings, same for their direct peers. What is telling is the price-to-sales ratio.
Which is?
Exceptionally high, over 50x on a trailing 12-month basis. That screams market is betting on massive future growth. It's all priced on future expectations.
Okay, intrinsic value, discounted cash flow DCF, Highly speculative here.
Extremely speculative. The entire value hinges on assuming a dramatic successful turnaround that's far from certain.
But for educational purposes, the model suggests a range.
Our model gives a very broad range of $3.50 to $7.50 per share. But again, massive caveats. This depends entirely on near-perfect execution.
And the key assumptions driving that range.
Highly sensitive ones. Aggressive revenue growth hitting those analyst targets close to $1.03 by 2025, over $3 by 2026, then slowing down.
And profitability assumptions.
That's the most critical and uncertain part. Assuming positive gross margins by late 2026, positive operating margins by 2027, that's a huge leap from where they are now.
Plus a high discount rate.
Very high discount rate, or WACC, between 17% and 20%. Reflects the high risk, the negative equity, the costly debt. It heavily discounts those uncertain future cash flows because there's a real chance they just won't materialize.
All right, that covers the fundamentals. Let's move to part 2 and see how the market views all this.
Chapter 4, Market Sentiment.
So Wall Street analysts, generally positive.
Surprisingly optimistic, yeah. Consensus is around moderate buy or buy. Looking at 8 recent ratings, half were strong buy, 1 buy, 3 hold.
Price targets.
Average target is around $5.91 to $7.06. But the individual targets are all over the place, from $5 up to nearly $9.50. And some firms, like Stifel and Guggenheim, have lowered their targets recently.
How's the media narrative?
Polarized. Highly polarized. You see positive stories about, say, their Q1 revenue being their highest ever, or the successful capital raise buying them time.
And the negative.
Big focus on the abrupt CFO departure, the stock drop, the securities probe, plus ongoing attention from critical short seller reports. It reads like high drama, exciting tech promise versus shaky finances and governance worries.
Okay, short interest. This sounds significant.
It's exceptionally high. Over 72 million shares short in late May 2025. That's somewhere between 30% and 35% of the public float.
Which means?
Profound market skepticism. A huge number of investors are betting the price will go down. It clearly marks EOSE as a classic battleground stock, fierce disagreement about its future.
And technically, price versus moving averages.
Interesting picture there. The current price, $4.21, is below the 50-day moving average, $5.11. That suggests bearish short to medium-term momentum, likely thanks to that CFO news.
But compared to the longer-term average,
it's actually slightly above the 200-day moving average, $4.15. That's generally seen as a more bullish long-term signal.
So that divergence kind of sums it up.
Perfectly. The 200-day reflects the long-term potential bullseye, while the 50-day shows the impact of recent negative news. The stock's right at an inflection point news could really push it strongly one way or the other.
Makes sense. So who actually owns this battleground stock?
Chapter 5, Ownership Structure.
Institutional ownership. Seems low.
Relatively low for a billion-dollar company, yeah. Around 23% to 39%. That reflects the speculative nature many big institutions might be staying away for now.
Who are the key holders?
Big index funds like Vanguard, BlackRock, some specialized funds too. But looking at recent trading, like Q1 2025, institutions are divided. Some added shares, others sold out completely. Reinforces that battleground idea.
What about insiders? Management ownership?
It's in the low single digits, maybe 2.4% to 8.6% overall. CEO Mastrangelo holds less than 0.5%.
And recent insider transactions. This seems like a red flag.
It's definitely a concern. Consistent insider selling over the last 3-6 months with 0 open market buys.
Especially that cluster of sales in May 2025.
Right around the CFO departure. The CEO, Chief Commercial Officer, General Counsel, all selling shares. That's typically viewed as a strong bearish signal from those who know the company best.
But then there's Cerberus Capital Management, a big strategic investor.
Well, exactly. They have significant influence through their investment and a term loan. Their potential equity stake is capped around 34%, depending on Eos hitting targets, and they have a long lockup until mid-2026.
So how do you read that? Insiders selling, but a major financial partner locked in.
It's a complex, contradictory signal. Heavy insider selling looks bad, but Cerberus making a long-term capital commitment is a powerful vote of confidence. Investors have to decide which signal carries more weight, the insiders heading for the exits or the strategic partner digging in.
Okay, let's try to wrap our arms around all the risks and opportunities with a SWOT analysis.
Chapter 6, Risk Assessment, SWOT Analysis. All right, let's start with strengths. Internal competencies. First, their proprietary Znitha tech. Safety, low-cost, abundant, recyclable materials. That's core. The U.S.-based manufacturing Pennsylvania facility gives supply chain security, plus those IRA benefits.
And third,
That significant commercial pipeline. The $680 million backlog, $15 billion opportunity pipeline, it shows market demand is there.
okay, now the weaknesses. Internal limitations.
Number one, chronic unprofitability and the high cash burn. Deeply negative margins, constant need for financing, which is often dilutive,
Number two.
balance sheet insolvency. Negative equity means they rely entirely on capital markets staying open to them.
Three.
Manufacturing execution risk. Everything hinges on scaling those automated lines. It's complex, high risk, delays, quality issues, lots can go wrong.
And four.
Governance and leadership instability, the CFO mess, the investigation. It damages credibility at a critical time. Now, opportunities. External potential.
The market itself.
Massive and growing LDES market. Multi-billion-dollar opportunity fueled by the energy transition, grid needs.
Government help.
Favorable policies, especially the U.S. Inflation Reduction Act, big tailwinds. Potential for international growth. They're looking at the UK, India.
And new demand.
Yeah, this surge in data centers needing massive, reliable power due to AI growth. That could be a whole new vertical for them.
Finally, the threats. External challenges.
Intense competition. From lithium-ion giants, but also other alternative tech startups nipping at their heels.
Technology risk.
Technological obsolescence. The battery world moves fast. Someone could come up with something better, faster, cheaper.
Pricing pressure.
Sustained pressure, especially from low-cost Chinese lithium-ion producers, makes achieving positive margins even harder.
What about macro factors? Interest rates, inflation.
Both hurt. Higher rates increase EOS's borrowing costs and their customers' project financing costs. Inflation drives up material and labor costs, squeezing those already negative margins.
And those U.S. tariffs from 2025, a complex threat.
Yeah, it's tricky. Could make imported batteries pricier, helping Eos compete, but could also raise Eos's own costs if they import materials or equipment. And the uncertainty alone causes project delays across the industry, which hurts pipeline conversion. It's not a simple tariffs are good for Eos story.
Okay, we've laid out a lot of pieces. Let's try to synthesize this into a conclusion.
Chapter 7, Conclusion. So, summing up the bull case. Eos is in a huge secular growth market, LDES. Their Zyntha tech has real advantages. Safety, sustainability, US-based supply chain. They have that massive pipeline and backlog showing interest. And, crucially, the recent financing bought them runway to execute the manufacturing scale-up. That's the optimistic view.
Now, the bear case. The flip side. Their financial situation is incredibly precarious. Huge losses, terrible gross margins, burning cash rapidly, insolvent balance sheet. The entire investment rests on flawless execution of a very difficult manufacturing ramp-up.
And don't forget the market skepticism, the massive short interest, the insider selling, plus the cloud from the CFO departure and the fraud investigation. It's a heavy burden.
So, revisiting that intrinsic value range from the DCF, $3.50 to $7.50.
Yes, that was the range from our educational model. But we have to stress again, it's highly speculative. It depends entirely on those aggressive growth and profitability assumptions actually happening, far from guaranteed.
Now, the current share price, $4.21, sits where in that context?
It's in the lower end of that speculative range, which kind of reflects the market's deep division. It's way below analyst targets, suggesting upside if they execute perfectly. But it's also way above zero, meaning the market isn't pricing in complete failure either. It's pricing in some chance of success, but with heavy discounting for risk. So the final takeaway, an investment in Eos Energy Enterprises today. It's not your standard value play. Not at all.
What is it then?
It's a high-risk, potentially high-reward bet, almost like venture capital. You're betting on a disruptive technology, on a management team under pressure, and on their ability to pull off a very tough operational turnaround in a super competitive market.
Meaning the outcome is likely.
Binary. Either they succeed in scaling and eventually reach profitability, leading to substantial gains, or they fail, run out of cash, and investors could face a near-total loss. It's really that stark.
Okay, let's unpack this. If you found this deep dive valuable, we invite you to like and subscribe to Stock Analytics AI. Remember, for just €4.99 a month, members get priority deep dives on the tickers you care about most. Over the next few months, we're covering all of the S&P 500 stocks, and members get exclusive priority access. If you'd like a one-off deep dive on a specific stock, just drop us a super thanks.
And the important disclaimer. This analysis was generated by an AI system for educational purposes only. It should definitely not be considered financial advice. Please, always conduct your own research or consult with a qualified financial advisor before making any investment decisions.